We got stocks sliding again today, negative trade headlines hitting markets, and joining us now to discuss where we go from here is Teddy Parrish, founder and CIO at Parrish Capital. So, Teddy, let's talk about the trade war. You say it's coming at the worst point in the cycle, which I find interesting. Could you just kind of outline for us what exactly that means to you? What point are we at in the cycle that leaves us so vulnerable to the impacts of a trade fight?
Well, I mean, we're at a record length in economic expansion, and we just came off of a tax cut that boosted earnings so much last year, and we're in need of a catalyst to go forward. And I just don't think that, a global disruption in supply chains as well as a decrease or a lack of exports because of a trade war is positive for the economy. The worst time in the world to do that. I mean, the Fed's decreasing rates now, and we're obviously having growth issues, and we're seeing some of the leading indicators actually contract a bit. I'm just hoping that doesn't roll over and get worse.
Hey, Teddy, Brian Chung here. So it seems like the Federal Reserve is interested in regrowing its balance sheet. That was a line that just crossed maybe a few minutes ago. Now, we don't know the details of what that would be, but we did see markets flinch just a little bit before the trade headlines kind of took back over again. Would there be anything about the mechanics of that, if they were to announce something in October 30th, that's their next meeting, that would maybe move markets again or be a catalyst, or is this really not that big of a story?
I think it's a huge story because it's an unconventional attempt to stimulate the economy. He said that it wasn't monetary stimulus, but it is. It's just like the bond buying program we had back when in our last recession. So maybe they're going to increase their balance sheet, do a one interest rate cut, and then stop for a few quarters. But it is a big deal because it's an unconventional way to actually boost stimulus.
Can we talk about a couple things that you like here? Your overweight staples, energy, financials, communication services. A name that stands out to me that we've been talking a lot about recently is AT&T. I don't know if you saw the Joker. Did very well. People seem to be into this name following Elliott Management getting in. What is it that you like about it?
It's an old, boring name that's right in the middle of this whole 5G deal that's about to come on the market, as well as having a great wireless franchise, as well as content. And what attracts me the most is their growth has stabilized and it's about to reaccelerate, and they have a 5% dividend yield, 5.5% dividend yield, which is very attractive right now with the market being so volatile.
And, Teddy, when you look at right now, you're talking about a defensive name, right? I mean, are we going to find a point in this cycle? We were just talking earlier in the show about earnings season. The hurdle has come down so far. Is there going to be a point perhaps where expectations get so beaten down that we start to see investors excited again about growth prospects and not just saying, let me get defensive and take my dividend and sort of preserve my capital here?
Well, that's why I believe this third quarter is probably the most significant earnings quarter that we've seen in a while, because we're going to find out if what we're seeing from some of the companies like FedEx came out and said that they're thinking about cutting capacity, and then we got the PMI numbers that say that things are slower. Now we're going to see what companies are saying about 2020, and that's all important going forward. For 2020, we're expecting 10% growth. Is that number going to hold up? If not, I mean, that's probably going to affect the market. But we got to go through that whole earnings pullback, which may mean the market going down a bit before we see the euphoria and excitement about what comes on the other side of it, which is growth.
Teddy, right now, any winners and losers that you like in the market in terms of making a play here?
I like Gilead Sciences, which is a cheap biotech, which should be an oxymoron. It's trading below the market in its industry from a PE, price to book, price to cash flow basis. It has zero net debt, and it has a dividend yield of 4%. They have a great Hep C and HIV franchise, and they're really, really trying to grow their cancer franchise. So I think that's a good biotech for defensive accounts.
All right. Teddy Parrish, CIO at Parrish Capital. Thanks for joining us. Talk to you soon.
Thanks for having me.